Hi, and welcome to Hedge Fund Manager. I'm Karl-Mikael Siding. So let's take a look at the fundamentals of Equinor. But right before we begin with the P equals F times V model for Equinor, I think it's about time we actually checked what Equinor does for a living. So you can use Koifin and click the snapshots down here on the left and the description button. And you'll see that Equinor is an energy company, engages in exploration, production, transportation, refining and marketing of petroleum and other forms of energy in Norway and internationally. Well, that is what we would expect when we are talking about an oil company. But it's good to know that you can always check the description in Koifin. It's usually very accurate. You get an instant understanding of the operations of a company. For some companies, you might actually be a bit surprised that you didn't know this about a company, that you thought you had an intuitive understanding of what they actually do. So I do recommend from time to time when investigating a company to check this snapshot description part of the company, just to make sure that there are no surprises in terms of what they do. Some of these descriptions are much longer than this one because they have very diverse businesses. So it's a strong recommendation of mine to actually check these things. And now when we're moving into the P equals F times V analysis, remember, because this is one of the more important lessons for this run-through, is that the PFV is a framework. It's a way of looking at companies and their stocks. It's a way of handling this interplay, as I call it, between actual real-life data on the one hand and investor sentiment on the other. So you have the reality here, and then you have the valuation. The valuation is really just fantasy, projections, forecasts about the inherently unknowable future. But we have to do something. We have to assume that the past is a representation of at least part of how the future will look. But we can never know exactly what the future will look like. But we have a lot of historical examples of how a certain 10, 20, 30-year period, how that is followed by another 20, 30-year period for companies and for the economy. Usually there aren't very big changes. So this is what I call my status quo framework, that whatever happened before is likely to happen again. There's nothing new under the sun. All these tropes I think are useful when investigating a company. So this is the framework. Sometimes I use it the way I've showed numerous times. I look 4 years into the future. I assume that by then the company will have normalized in a way, that their valuation multiples would be a warranted average of what they really should be and what the market is usually valued at over long periods of time. I also assume that by then all this extraordinary stuff that happens in a company, that we have left them behind us and we are in a normalized state of profitability and growth rates. So I assume a normalization of both a set of fundamental values, so the reality, and the valuation multiples that the market will or should award the company, given what those variables did up until then. But you don't have to do it exactly this way. The PFV framework is just a way of saying that you should tease apart these two aspects of a stock and a company. And you can do that in a lot of ways. So for Equinor, I'm really not looking 4 years into the future. I'm staying right here, and I'm saying that they have a certain set of fundamentals, and I will only step those forward 1 year at a time and see what type of returns that they will award me. So now let's look at Equinor's fundamentals. And you can see here that I'm using sales, I'm using nominal sales. I'm just looking at what is their actual revenue from quarter to quarter, rather than trying to analyze their growth rates, because this isn't a normal operational company that is inventing products and marketing them to new clients or trying to find new avenues of growth. They're simply extracting oil and selling it at the world market price, and that creates another pattern of income. And what I see when I look at this picture is that Equinor, the last few years, they have a more or less stable revenue level of around maybe 30 billion, the last quarterly level here, maybe slightly below. Sometimes the price of oil makes it explode upward for a short while, and sometimes there is a depression in the oil price, meaning lower revenues. But unless I have a strong view of where oil prices are going, you shouldn't expect very much higher volumes from Equinor. They have a stable set of operations, and they are not really investing in order to try to expand. Rather, the entire oil business is in decline in a way, or at least plateauing because of environmental concerns. That is also part of the risk of investing in a company like this, even if it seems cheap. The diluted earnings per shares is also pretty flat. I did cut it off here during the boom year of 2022, but you can see it's pretty flat, at least here for the last few years, except for that spike there. So maybe they are making, let's say, $1 per quarter or a little bit less. But unless we project very much higher oil prices, this should stay more or less flat. We can also see what other analysts are saying. So let's check in just the snapshots overview picture here. Then you can get the analyst estimates right down here on the right side below corner, because sometimes unless you pay for a pro version, you will not get hold of analysts' estimates in this program, in this Koifin program. But here you'll always get at least some idea of what analysts are projecting. And you can see the year-on-year changes are more or less flat, maybe a couple of percentages, both for EPS and sales. After clicking enterprise value right here, you'll get a view of the market cap, their cash, their debt, and of course their enterprise value. And as you can tell here, the market cap of 65 billion is not very different from their enterprise value of 70 billion. This is actually a pretty good picture. I think all companies should have at least some net debt. It's simply efficient. In any case, when the difference is like 5, 6, 7%, as in Equinor's case, I treat price sales and EV to sales, EV to EBITDA, etc. I just treat them as the same key ratio, because the difference is so small. And in any case, we don't have that precision. We never have a precision like that when valuing companies. So that was more or less unnecessary to check the enterprise value in this case, but you should always do that. I do it when I come across it in the normal course of doing the P equals F times V, and sometimes you also know that there's probably some interesting information there. You know that beforehand. In any case, you should always check it sooner or later before making an actual investment. Okay, let's check a few more fundamentals. So we've been through sales and earnings per share. Now, actually, let's check their equity. So this is their net assets. So it's remember that the book equity, sometimes you call it book, sometimes you call it equity, sometimes you call it net equity or shareholders' equity. This is the residual that you own when you own a share. So the equity doesn't actually exist. So what it is it's the difference between actual assets minus the debt, whatever is left in between, that is what you have the right to as an equity or a shareholder. So you're actually not really owning anything except the difference between these two real things. So the equity part is really just a made-up fantasy of fugazi, whatever. Anyway, so let's check the equity progression for this company. And it's maybe a little bit surprisingly, it's kind of stable. The chart here doesn't. It looks like it's cyclical, but look at the values. The difference is between the bottom here at 35 billion and where it is right now at 45 billion. It's not huge, and the 40 billion level here is some kind of an average. So it seems that they have a pretty stable net equity value. That means that we can value this company using equity as our basis of the valuation, because they are not growing, and they are not making huge dividends, and they are not shrinking. Sometimes they accumulate a bit of equity because they make a lot of money, but then they probably just pay it out in dividends to get rid of it. So this is the size that Equinor seems to be aiming for. And that means that we can look at price book valuation measures in order to perhaps make an even more precise valuation. And right now, Equinor is at 1.4 times price book. It's at the very low end of range for them. Sometimes they have just about hit 1 times book. And sometimes they've been as high as 3 times book. That takes quite a bit of optimism to believe back in 2022 that oil prices will remain this high for a long time, or even increase from there. But there was a little bit of an oil market scare around here, and a desire to protect against inflation, and inflation that might creep into resource prices and commodity prices. Here at 1.4 times, well, let's see if that's a reasonable level or not, no matter if it's low at the low end of the range or not. So I brought up the return table. I can show you how to find it. Here we are at the financial analysis. We're right now still at the enterprise value tab. But let's check what we got. We have return on invested capital, solvency, profitability. Let's click profitability. And here we can see the return on assets, historical return on assets. It's right now at 13%. It's been at 13% or 10 plus minus a little bit for quite a few years. Let's look at return on equity. Here we see numbers ranging from 18-19%, quite often 18-19%, and sometimes actually a negative return on equity. And here we have this super year in 2022 where they reached 60% due to these super high oil prices. But it seems that this is a company that should be able to generate about 20% return on equity. And at 20% return on equity, some would say it warrants a valuation of 2 times book. I would say that maybe 1.5 times book is more typical. Depends on what type of growth rate you expect or dare to project into the future. And this is not a conclusion, a final conclusion. It's just a first stab at looking at these valuation multiples and see if they are reasonable, if they seem very high or very low. Then we move on to EV to sales. It's at just 0.6 times sales versus sometimes at 1.5, even 2 times sales. It's actually several times in history. 1 time sales seem to be used to be a kind of a floor, and 1 time sales if you have a net income margin of 8.6% rather than the historical average for S&P 500 of about 7%, then you should warrant about 1 to 1.5 times sales, actually, especially if you grow at least a little. We can look at EV to EBITDA. It's actually less than 2 times their EBITDA. That's a pretty low valuation. Somebody is not liking this company. It could easily be 2 times that valuation without raising any eyebrows. And then let's look at their dividend yield, also from Koifin. They're right up there at 9% dividend yield, coming from levels of 2, 3, 4% and maybe a 5, 6% average. So a 9% dividend yield, that's really, really good. We can also check what their free cash flow per share is from their accounts. And even if it's been falling lately, it's still as high as 291. If we divide that by the share price, we come to a 12% free cash flow yield. That is what we implicitly get when we buy the company. This is the cash flow they are actually producing. So if we were to own the entire company, we would get a 12% free cash flow yield. We could leverage that up and get a 25% return on our equity if we wanted to, if we own the entire company. So Equinor seems very cheap on many key ratios. But why? I would say that it's simply that oil stocks are not loved. They just won't catch a break. The question now is it cheap enough? What if it stays cheap forever? The risks with investing in like a dirty oil company are political, regulatory. Perhaps nobody, private equity, don't dare to take it over because you don't want to assume this kind of political risk and put this company in runoff. The question now is, what does the P equals F times V model really tell us? Well, next up is the CAGR calculation and the comparison with other investments on a risk-adjusted basis. So let's take a look at that in the next section.